Hi, everyone, and thanks for joining today's panel at the Finance Magnet Virtual Summit. My name is Ron Finberg, and first of all, I want to thank Finance Magnets for again inviting me to participate in one of their panels. This year we have a virtual summit instead of the London Summit, and hopefully by next year we'll be back doing this again. I think this is the 8th year that I've actually been involved with one of the Finance Magnets events and speaking in the panels. In my current role, I'm a product and regulation specialist at Capitec, where we provide technology solutions for EMIR, MiFID, and best execution reporting, and work with many CFD brokers. So as my work puts me in the middle of regulation, I was asked by Finance Magnets for ideas for this year's panel. And I thought, we've done the MiFID and EMIR quite a few times on whether the London Summit or the IFX Expo. So I thought maybe we'll do something different this year. So I thought market surveillance might be a good place, great topic for this year. And I think that the topic really became more relevant due to COVID-19, market moves of COVID-19, and people working from home. So working with me today to really get this off the ground, we have some great panelists, some industry specialists that are going to share their ideas. They've either are involved with it currently or have been implement different strategies in their own companies, as well as have a lot of feedback from regulators. So to get things off the ground, I'll let everybody introduce themselves. So Shai, let's start with you.
Hi, good afternoon. My name is Shai Chefetz. I'm the co-founder of the SOM Digital. In my previous role, I was the CEO of Integer Limited, a CFD broker. So I've worked both sides of the fence.
Mark?
Hi, I'm Mark Kelly. I'm founder of Regulatory Advice Limited. I have a background in IT and audit and compliance, and that crossover between IT and compliance has meant that I've specialized for the last technology, in particular transaction reporting and market surveillance.
Thanks. And Shiran?
Hi, my name is Shiran Weitzman. I'm the co-founder and CEO of Shield Financial Compliance. Shield is a RegTech software company specializing in the full life cycle management of electronic communication compliance, and that including the full record management to the surveillance of the ECOMs. So a full ECOM surveillance, including all the whistles and all the hoo-ha of electronic communication requirements.
Okay. Specifically
for this topic and market abuse.
Great. So thank you, guys. Before we start, I just want to mention to everybody watching today, so if you have questions for the panelists, there's a question pane. You should be able to just enter your question. Following the panel, there's going to be a chat message board where our panelists will be able to get back to you on any of your questions. So with that little introduction, so I thought, Shiran, maybe we'd start with you. I know you mentioned you're involved with communication for market surveillance. And I think the whole idea of ECOM for market surveillance among a lot of the CFD brokers, or just, brokers in general, aware of, everything's over the internet. So maybe you can just a little bit of background of what ECOM, what is ECOM and what are the areas of market surveillance that people probably should be aware of.
So ECOM is not e-commerce, right? It's electronic communication. It's it's there. Well, electronic communication is something that has been evolved over the years, right? If we are looking back 10 or 20 years back, it was mainly voice communication that took via these big turrets that the traders were communicating with. Afterwards, the terminals and the chat capabilities within the terminal, specifically from Bloomberg or Thomson Reuters, has been added. And this year, it's coming, and I would say specifically since all the revolution, all the digital collaboration revolution that happened almost 10 years ago.
Did Shiran cut off everybody else? I think you just got.
I was down. Electronic communication is really everything that allow humans to communicate, right? That's it. It can be voice, it can be text-based, it can be everything around that, right? So these days, the really electronic communication is all around any voice channel, any text channel. In text channel, we are talking about the financial chats. So it will be the Bloomberg, the on the Symphony, the ICE chat, all the specialized chat rooms for traders and brokers to communicate and exchange information and idea. It will be email, all type of email channels. Our Office 365 is the massive one, but overall any email client and any collaboration chat. It can instance messages, it can be Teams, Zoom, Slack, any type of electronic communication that people exchange idea. And we start to see more and more the social media part of it, right? So social media, it will be the WhatsApp, it will be the workplace, it will be the Twitter, it will be LinkedIn. It will be, again, things, channels and ways for people to communicate externally or maybe internally, right? The idea around electronic communication within financial services and specifically within market abuse is that almost everything is allowed. They just need to be monitored and following the policies and the rules of the organization. And according to that, right? If the organization is allowing, I don't know, is allowing Telegram, they will never do. But let's assume they need to have in place a way to properly monitor and surveil and keep the data for X amount of year, and to be able to conduct investigation and to alert on any market abuse or employee misconduct around that. So that is the wider scope of electronic communication. One bit with the introduction of Teams and all the internal communications, all the internal collaboration world, I would say that even documents and SharePoint is a mean of communication between can be a mean of communication between employees, simply because it's something that in real time you can exchange ideas. So the wider scope of it, any means of human communication is ECOM surveillance.
Okay, and Shai, I wanted to just on what Shiron was mentioning, as your work when you were CEO of InterTrader. So in terms of just doing your reviews for digital messaging, as an internet company, really as a broker, how much of this was a challenge for you guys to really collect all this different data?
So the collection of data is a challenge, but that's not, in my view, the real challenge. And I kind of want to touch on it. There's no one solution that will cover all communication channels. Even more important, if two individuals or more would like to keep their conversation confidential and no one will know about it, they will find a way to do that. Specifically today, when you have end-to-end encrypted systems. So the solution is actually, it doesn't start with technology. The solution starts with culture, the culture of the organization. The understanding that the employees understand that surveillance is important and good conduct is required. In the game of cat and mouse between, I would say, the employees and compliance, the employees will always win. There is no way, you will never be able to cover all methods of communication. Saying that, there has been a very significant development in the creation of holistic e-communication surveillance systems, which covers the combination of both voice and text communication across most known systems today. But that created another problem, and that is the vast amount of data which is wasted. That in order to actually really understand what has happened in the communications, you need to have a system that will turn the text enough. You can't just try and turn the voice into text and put catchphrases in place and you think that's surveillance. Surveillance is made way
You're breaking up there.
More than that. It's
Shai, you're breaking up a little bit.
The context of the conversation. So Yes.
Yeah, so
Okay.
you're breaking
There is
up
a
bit.
problem with your audio.
Yeah, so maybe Shiran, I know maybe if you can just continue on what Shai was saying, because you mentioned a good point in terms of the compliance, the compliance versus trader, kind of like a cat and mouse game. So I'm curious.
Yeah.
I'm curious from your end. What are kind of like the requests that you get? Because obviously you can't just be looking for those catchphrases or certain thing. Make money now, like on every internet, on every mail, things like that. What are those ways for being able to kind of like outsmart what people are looking to do in terms of just being abusing their outbounds with their clients?
So I would say two things. First of all, you would be surprised that the regulators are looking for when they are auditing the systems, the customers, the financial firms, they are looking for these obvious catches. They will look for the phrase front running. We don't understand why, but they are looking for it. It's kind of you need to have it. But the reality is that we need to work with semantic, with context, with understanding hints and the meaningful of a conversation or a phrase. We need to understand the conversation context, what happened before, what happened after. We need to understand who communicated with whom and what their role is. So it's a lot of enrichment and metadata that involve. And yeah, if someone wants to take it offline and discuss in a non-authorized channel, let's assume that they are talking in an encrypted channel, let's say WhatsApp, right? Then we are not recording the WhatsApp, or unless the organization is approving and is mandating to record the WhatsApp and to capture it. Assuming that it's not, okay? And they can also write a piece of in a piece of paper, right? Everything, if they want to conceal this information, it's doable. But we believe that for some of them, we will find hints in the ongoing conversations, right? And the idea is eventually to combine or to link the trade itself, right? Which the trade itself or the transaction itself is a mathematical, it's an evidence, right? And the intent that is available in the electronic communication, right? So a lot of things you may not capture in the ECOM. You may see it in the trade, and a lot of things you cannot see it in the trade, but you will find intent on, you will send comment, and you will sense that something is wrong in the electronic communication. It needs to go hand by hand or hand in hand. It needs to go together. ECOM itself is a complementary system to the trade surveillance, right? This is the evidence. This is where the transaction happened and money exchanged. What happened or how people colluded, how people were speaking in order to front run the market or in order to rig the foreign exchange rates. This is something that that may happen in electronic communication. And I have to say one last thing. It's like in the Big Brother, like in any reality show. Eventually, people are getting used to the communication that is being given to them, and people specifically that they are not criminals by essence, right? They are not trying to look for espionage tools to try to rig the market and to do it. Some of them are doing it. There's all the exotic cases that we read at Bloomberg, but most of them are just cutting corners, right? And these cut corners that you eventually want to find, and you want to find the real criminals. You also want to get ideas coming from different systems and to connect the dots together. So that's eventually I hate the word holistic, right? But this approach, combining all elements coming together from different data sources, that eventually should give the firm the full picture. Now it's an evolving industry, and it's an evolving situation, and the work environment and the amount of tools that we are using is evolving as well. So it's a very interesting period to be in.
Okay. Shai, I want to go back to just on what Shiran mentioned about at the end of the day, there's a connection between the trades and the ECOM. So I know in terms of just CFD brokers, in terms of the trading side of doing surveillance, so a lot of there's a lot of questions on what falls under market abuse, what doesn't. So, I know one area that you were involved with was setting up the market surveillance with stocks, with stock CFDs. So maybe you could provide some like insights in specific areas of when viewing your clients' activity. What were areas that you were specifically looking for when you're doing surveillance on them?
So we can't go into too much detail because the actual surveillance methodology itself is not something that the regulators would like everyone to share out. Principles, you're looking for the basics of market abuse, which are primarily insider trading and attempt insider trading, market manipulation, and attempted market manipulation. So these are the 4 areas that MAR covers. When it comes to insider trading, usually insider trading is associated with information. So you will seek to understand if there's been information that then it went into the public domain, but someone has taken some action ahead of that information. That may give you a hint that maybe he has known something that someone else didn't. The second part is more associated with market manipulation. Market manipulation is when there is no logic or there is no symmetry between the action the client has taken and the actual outcome. His actions do not make sense. And then you're asking yourself, what is the motivation behind that action? Because that action in itself doesn't make sense. So in broad principles, that's what it is. Then going into the details, you can find, as I think as Shiran said, there are a lot of hints of implicit information that may tell you and that something like that just took place or may have taken place. At that point, you have one date with other data points. So if you start with a trade that looks suspicious, then you go, okay, so let's look at the communication around that trade. You cross the communication, and then you're looking at the general client behavior. Is it consistent with the behavior around this activity? Then you're looking at that client against other clients. So you're starting to cross a lot of different data points that may not be relevant. It's like building a puzzle. And at some point, the picture that comes out, and suddenly it becomes very obvious that either it was legitimate activity and everything's fine, or it seems fine, or you find what you call is a suspicion that there was some criminal activity that took place. Now, as a broker, you're not the police and you're not the court to anyone. All you need to do is have a reasonable suspicion. Once you've established a reasonable suspicion, you report it to the regulator, and from that point onward, you have done what you were required to do. And then the authorities will take the next steps, and they may require more information from you. They may take other steps, but your job as a broker is to identify them, inform the relevant competent authority, and from that point onwards, carry on with your job.
Okay. I think Shai, what you mentioned, I think is a very important point, because I've just heard this from different firms. They kind of sometimes it gets a little misunderstood in terms of a company's obligation is really just to report it and not to stop insider trading. That's not the broker's job. That's the judicial system and the regulator's job to get involved with. So I think it is important to kind of highlight that, because some firms, I've heard some firms kind of get a little too crazy. It's really not their, it's not necessarily their job. But Mark, I want to just continue on what Shai mentioned in terms of just differences between a CFD broker under market surveillance as to other brokers that are providing listed products. What other areas are, what falls under market abuse trading wise that the company should be understanding other than some of the items that Shai was mentioning?
Yeah, if I could just wind back a little bit, I can see two issues that have been referenced by Shiran and Shai. One is you're not going to catch everything, and bear in mind that what we're trying to go for is for the firm to have a reasonable defence, for the firm to have mitigated the risk and to be able to demonstrate to the regulator that they've done everything that was reasonably possible. So for these things that you're never going to catch, you assign to say they're not doing bad things on a regular basis, and that sort of helps scoop up some of the things that might otherwise not be caught. The second thing that can go wrong is you do collect the data, and Shiran has said all of the multiplicities of data streams that you might try to get your arms around. There's a big danger that you might collect the data, but then not have the right filters to analyze it and pull out the problem. So you need to know what bad looks like in order to apply some filters and some expert rules to the data you've collected. So you've got to think, what are the high-risk scenarios? The high-risk scenarios might be, a big spike or a big dump in a particular price, and then you look at, who's acted with perfect market timing and made the most from that. And then you look a bit further into that client and say, hang on, do they work for the company that was just subject to that price spike? So you've got to have, you've got to have a catch-all for things that you're not going to see, but you have to have very intelligent filters to make sense of this wealth of data you're now capturing. Okay. In the CFD specifically, it's very different. And if you get a surveillance package out of the box, a smarts broker or an Actimize or something like that, what you're going to find is that they're very tailored towards exchange trading, and particularly in supporting exchanges. So they'll have very good reports which tell you about spoofing and layering and all of the tricks that can be done on an open order book. But the CFD brokers don't really have that. Normally you just see one price. And even if someone's put in lots of limit orders, they aren't visible to the other people who use that CFD broker. So you're not really looking at people manipulating the market by putting in bogus orders. You're looking for something different. And I would say if you're doing the risk assessment of how your CFD firm is most at risk within the market abuse regulation, you really want to be saying, well, we'll mark this spoofing and layering, the manipulation of orders, as lower risk, and the insider dealing aspect as higher risk, because we've seen plenty of examples of people who know inside information, and rather than just go and buy a big block of stocks, which is very visible, they'll go and execute it via a spread bet or a CFD to get a surreptitious position in the stock they know is going to appreciate. So that's the main difference. It's more about insider dealing. It's less about market manipulation when you come to the CFD brokers.
Working with lots of data, whether it's reviewing, messages, the electronic messages, or reviewing traded transactions. Is this anything that people can do manually, even on the trading side, just looking for the big moves, or at this point does everything have to have a technology solution to really have market surveillance?
Of course, they can do things manually. Most of them are still doing it now. Downloading to Excels and looking in a lot of different systems, but it's very limited. And again, you can have an army of compliance officer, no problem.
It's always going to be a mix. It's always going to be a combination, because at the end, compliance officer weighing everything up and saying, does this pass this threshold where I need to submit a suspicious trade report?
I think when it comes to manual work, there is a high probability that you would lose the trees from the woods. Is that you are dealing with so much information and you're just processing and processing. At the end, when there is actually something suspicious, it will just go under the radar because the vast amount of information. So is it possible? Yes. Is it effective? No.
It's also expensive, but yeah, it's mainly not effective.
Mm-hmm. Okay. And in terms of Shai, in terms of just finding those false positives, and that Mark was mentioning how you can go through everything, but you have to know what's bad and what's good. How do you identify those false positives in order to ignore them in the future?
I think when one applies common sense, there's one way at it, but I don't believe this is the long-term solution. I think the solution actually comes from artificial intelligence. So the use of AI is the best way forward, in my view, to analyze massive of information, understanding context and understanding relationships between different data points and trying to build relationships between them. So in order to understand and eliminate false positives and also identifying real positives, this is where AI comes in, and different methods and different areas of AI can be brought together to give you a holistic solution, which include neural networks as well as other methods.
Mm-hmm. Okay, I know, Shiran, I see you nodding your head there on when you
No,
mentioned
I agree.
AI, but
I agree. Although AI is a big thing, eventually need to be broken down to the bits and bytes. We are doing it. First of all, let's set the scene. False positive will happen no matter what, right? This is the nature of the amount of the data and the nature of the things. What we want is to reduce the amount of false positive and increase the relevancy rate of what we detect, right? So instead of this 0.01 or 0.1% of true positive, we want to make it a little bit more, a little bit better numbers there. And yeah, the combination of a traditional method like smart lexicons and especially in ECOMs, and a lot of AI and I would say supervised machine learning as well, getting feedback from the compliance officer and with time improving the scoring and improving the risk-based approach for that specific type of electronic communications, for that specific scenario of event that happened, that in time is, or and I would say the other way around, increasing the relevancy of the alerts that are being detected. Right?
I think you make a good point though, in terms of you need the feedback from the compliance officers. It's not just, no one should think, okay, I'm going to turn on my AI and then it's going to solve all my problems in the future. It seems to be you still need those inputs.
The human element is deadly important. I cannot underestimate how the human here is important in connecting the dots and then maybe teaching the machine in the future, but you do need that human.
You also have the regulatory expectation that you tailor your system when you first put it in to your specific firm environment, and then that you adjust the parameters or on the basis of experience and changes in your business and so on. So it's important, just from the regulatory perspective, to have that process documented, to know that you've got a development and a continuous improvement process, so that they can look and they see that you've taken that on board and that you're not just putting in a static system to get a tick in the box.
Yeah, and it's also important to say that the firms needs and wants to have the false positives as well. It's very important for the processes and the overall to check the system. And when we are talking about AI, by the way, one thing that is crucial to everyone that we speak with is the ability to explain to a regulator or to themselves, starting with, what is included in this AI, right? And that's a very difficult topic, right? Because
ask any trader and they'll tell you they have no idea what's in that AI. That's
it's almost it's a very tricky point, right? But we understand that there is a need to explain. It's called alert transparency for us. What is it? Why the alert popped up here? What have you done in the background? Which tools you use in order to have this alert, in order to suppress it, in order to boost it, in order to do something with that scoring. And that need to be transparent and need to be also later on to be exposed to the regulator or anyone who wants to review that.
Okay.
I want to touch on another point, I think, when it comes is the fact that once you reduce a lot of the false positive, your limited resource has more time to spend on the actual cases that you need to look into. Mm-hmm. And you can run a way more thorough investigation on each and every case. And I think we also need to remember the point of reasonable suspicion here is that when you are, as a MLRO, reporting an STR, you also need to consider the effect it may have on your client, because you may have an innocent individual and you are reporting them to the regulator, and that can have a chain effect on this individual's life while he's completely innocent. So you have to weigh your duty to the regulator, but also have to weigh on the other hand, there may be someone innocent here on the other hand, and you may be taking steps that can really change their lives.
That's a good point. I want to move things a little away from this a bit to another part of MAR, to the market abuse regulation. So in terms of market abuse regulation, one item that was not included under its scope was FX, spot FX trades. This makes sense. It's OTC. It's not a listed product. It's trillions and trillions a day. However, there has been some it was brought up from ESMA recently, and they had questions of whether it should be included within the market abuse regulation. Mark, I wonder if you can just give us some feedback on what you think, where you think the market is headed in terms of whether FX is going to be affected. I know specifically with terms of retail FX, if there's an area of concern for market abuse covering it.
Yeah, I mean, in terms of the consultation paper that came out, people shouldn't be spooked. That's not really moving it forward. From a common sense point of view, it's difficult enough for countries to move currencies where they want. It's very difficult to think that an individual or a firm is going to be able to manipulate the market, move it, and certainly no insider dealing unless you happen to know what future interest rates are going to be, which is becoming harder now than it used to be in the past. So we've got, after a lot of consultation, ESMA decided, do you know what? A lot of respondents said there's a global FX sort of terms of reference or dealing practice coming in shortly. We'll wait and see what that says, because we don't want to put something in from the European side which is out of line with what the global direction of regulation and best practice is. So they've stepped back from spot FX. It was funny that they didn't mention anything about derivative FX and kind of rolling spot contracts, which are what most CFD brokers are in. And I don't know whether it's just they didn't consider them or whether they think they're already covered by the current market abuse regulation. Now, I can't see that they're not covered by MAR as it stands, because MAR includes derivatives where the underlying is listed on a regulated market, but spot FX isn't. So I think the derivatives FX falls between stools. It's not clearly covered by MAR, and it's not being specifically legislated for in the future. However, I think firms, as we've seen before, where slippage has been misallocated, with firms taking beneficial slippage to themselves and passing on bad slippage to the client, it would be very hard for a CFD broker with FX contracts to say, well, it's not covered by MAR, if they were found to have actually abused the client in this way. So I think you should certainly have an eye on how what the dealing practice is. But in terms of being a safeguard, a barrier to stop your clients manipulating the market, I think that ESMA has come out in the right place and said, just let's leave FX off the table just for the moment.
Okay. Thanks for that. I guess moving on with regulatory talks, and now with Brexit imminently taking place, one of the topics has been if there's going to be divergence between what the FCA in the UK, their way of legislating, as opposed to the rest of the EU. So I'm wondering, Shiran, if you've seen any feedback in terms of potential divergence between the two sides after Brexit.
So I think they made it. Maybe Mark knows a little more than me, but from what I read, it's actually the FCA wants to make it very simple to EU entities, and so they publish the changes that they make to the MAR regime. The changes basically are designed that UK markets and the financial instrument continue to follow the same EU regime as stated before in the EU market abuse. Amendments are just specified wherever it was European. It's now European and the UK. So in terms of reporting, if you are sometimes you will need to report into two regulators, both in the UK and in the EU. But overall, the same duties and the same requirements. Only thing that is the FCA replaced ISMA as the authority that provides the technical standards and everything around that. Mark?
Yeah, we up until a couple of weeks ago, we couldn't really have answered this. The UK Treasury put the Financial Services Bill before Parliament, and this is just a catch-all, an umbrella bill, which basically just lifts and shifts all of the EU regulation into UK law. And in the very small section on market abuse, basically the only thing they've changed is to change the penalty for insider dealing from 7 years to 10 years. We still haven't seen many people caught by the existing regulation, but they're extending the penalties for that. But otherwise, it's going to carry on. You'll be expected to send, you always had to send in suspicious transaction or order reports to the FCA. That's going to continue.
Yep.
They'll have the same level of diligence. So really no change that people need to be aware of in the UK.
Okay, but what about cases where you have a UK company that's now opening up an EU entity, or an EU entity they're opening up a UK company, and usually you'll have like that one hub that's doing all the compliance or managing things. Can you continue to be managing, let's say, everything out of London for your EU offices, or there now has to be resources split between both the EU and the UK?
Well, you can certainly do the hub and the processing, and you can have your monster AI sat in the UK. But all of the kind of scrutiny and all of the submission of suspicious trade reports would need to be done by the entity to the regulator who's in charge of them. So if you've split up, as most people are, into separate EU and UK entities, the EU entity would report to their local regulator.
Okay, but I think bottom line, I think also the people in the EU as well have to know what's taking place under them or having access to that data. Is that correct, or can it be just?
In terms of what, to have the data separated in the EU and the UK?
Yeah, do you know what? It's a good question. I'm not sure that the data protection rules have been fully thought out. I haven't seen anything that says there's a firewall now. And whereas in the past there was always a little clause that says this data won't be transferred out of the EU, I haven't seen any of those clauses being tailored to say this won't be transferred out of the UK. So I think firms will have to be careful about what information about UK individuals they can share within the EU and vice versa.
From our perspective, from data side, we recommend customers to keep the data separated per entity, basically. So the data resides in the UK and the data will reside in the EU in separate data hubs. Yes.
In my view, the regulators have an interest to stop market abuse in general and stop financial crime. And so they have a very, very strong interest to remain aligned. So I don't foresee significant divergence between policies because they have to work together. Now that clients reside within the EU and the firm is outside and vice versa, you cannot undo that. You cannot undo years of intermingling between EU and today UK. And they'll just have to remain aligned. They are forced to do so.
Okay, we're kind of getting closer to our time over here, but I want to quickly go over two last questions. So first to Mark, firms are providing cryptocurrency products, whether it's CFDs or just regular cryptocurrency exchanges. How does market surveillance fall in under those products?
Well, it's interesting. FX was obviously mentioned and discounted by ESMA's latest station paper on MAR. Cryptocurrency wasn't mentioned at all, even though crypto is one of those places which is famous for market abuse, for pump and dump schemes. But it's totally, they just don't think that it's something that needs regulating under the market abuse banner. However, as I said with CFDs on FX, it would be silly of firms to ignore those things, because you don't want to be splashed across the front pages as encouraging market abuse on your crypto platform. So what firms could probably do is to leverage, and this might not be a bad idea across the board, leverage some of the technology you've put in place for anti-money laundering purposes. And sometimes the alerts that that will generate will point to market abuse. You still might want to restrict an, but the only thing that people have to put in place within the EU in terms of surveillance is surveillance to catch potential money laundering. Now, there are tools available. People think that the crypto world and the blockchain is more opaque than it is. In actual fact, for the main coins, there's an online ledger. There's hundreds of copies of every transaction that's ever happened, you know, which is why Bitcoin that was taken in the Mt. Gox hack or from the Silk Road is on the move again. People are still able to track all of those coins. So, so the blockchain monitoring software that's available can say not only who you got the crypto from directly, but who sent it to them. And you can go back a couple of hops and make sure that you're not unhappy about the ultimate source of the funds. You know, you don't want to be receiving something from Mt. Gox or the Silk Road, or where it's being sent to, because you don't want to have, you know, a couple of blockages in the way, a couple of dead offline wallets in the way, and then ultimately your crypto ends up financing terrorism. So
Sure.
there's a lot that's available to do surveillance. It is geared more towards anti-money laundering and financing of terrorism than it is market abuse. But firms need to keep an eye on all of the crypto transaction trail.
Okay, Shiran, I'm curious. Are you getting any pickup from crypto companies looking for solutions on ECOM?
Not yet.
Not yet. Okay.
Not yet. But that's only now the normal firms are starting to implement it. Cryptocurrency will come afterwards.
Okay, but I know one area that has led to some uptick is so that's kind of just changed how people are speaking between themselves in the company. So what are some of the challenges that's led to companies in terms of applying their communication surveillance?
So I would say that this work from home situation, it really has several angles, right? It's and each angle contributes differently to the importance and to the comprehensive of ECOM surveillance platform. The first one is that employees are in a need when they work from home. They are in a need for additional channels, additional electronic communication channels in order to conduct their day-to-day job, right? So if in the past Zoom or Teams were just for individuals, now open, that's of course can grow as well. So the bottom line of this point is that the digital footprint of the organization and the employees is increasing because the number of the channels increase. Another point is that the traders are working from home and increasing the risk of market abuse, right? Simply by being at work, and they are all human, we are all human, and when no one looks, we may walk in red lights, right? It's a natural thing. Now, when we're working in the floor, when they were working in the house, or not in the house, where they were working in the trading floor or in the company, they had compliance on the floor, looking around and thinking and looking to be, is the nature of being in an audited or a monitored place is that you're a little bit more strict, no matter what. You're not, you know, I don't want to say words here, but you don't do certain things where you eat, right? So currently, now they don't have compliance at home, right? They work from home. There is no compliance at home. So that's the second point that's important to understand. The third point is that there is an increased risk on the usage of unauthorized channels. And we're talking about things that we talked before, the secret channels, the encrypted channels, things like WhatsApp or Telegram, or even just mobile phone and an SMS if it's not monitored, right? Simply, again, when you were in the floor, you needed to put the phone aside. If someone saw you, then it was a problem. Now you work from home, there is no compliance on the floor, right? And the third and the fourth item and the last one is that compliance cannot walk the floor and overlook and oversight the traders now. They are completely remote, and if they have no tool and no service in place, they're also completely blind. So these are the 4 items or the 4 main angles that are should bother any financial firm and any regulated firm. And to be just to conclude those and to increase the dramatic aspect of it. Just 3 weeks ago, Julia Hogarth, from the Director of Market Oversight in the FCA, made a speech, and she addressed 3 items in that speech. One big item was the work from home and the dynamics of work from home and the everything that goes around it, including the requirements to continue the oversight, and that they see it basically as almost transparent, the fact that they are working from home and they are working from the office, and they expect the firms to be a very tough policies relating to the new work environment, especially when it comes to private devices, especially when it comes to insider dealing and market abuse. So all of this is in the process of enforcement, I think, by the financial regulators globally. Also took a speech and published that. But
Okay.
These are the dynamics that need to be considered.
All right. Shai, just to end, do you have anything else to add in terms of just Shiran mentioned the FCA, how they had their kind of focus on MAR regulation? Was there any areas specific encounter that the FCA was asking you about in terms of surveillance that you thought were interesting or important for people to know about?
I can't address any questions that were presented to me by the regulator.
Okay.
But I can give you some broad general comments. So in my personal view, the FCA has demonstrated significant patience with CFD brokers in general. It's been very, very patient, but I think their patience has expired or is about to expire very, very soon.
Patience in terms of surveillance or another?
No. They've been very patient with enforcement.
Got it. Okay.
I think they gave a lot of firms a lot of rope to get things right, and they've allowed them the time required to get things right.
Mm-hmm.
The FCA does not see CFD brokers as contributors to financial markets. Consumers mostly lose money with CFD brokers, so there's no benefit there on one hand. On the other hand, they're a massive source of market abuse. So I don't think CFD brokers can expect any love from the FCA or any other competent authority in that matter.
Yeah, they have had more fines as a group within a sector within financial services. They've had more fines for transaction reporting, insider dealing than almost anyone else. I think that MAR was an overlooked orphan when it came out in 2005. It was eclipsed by EMIR and MIFIR, and now I'm starting to see clients receiving very tough letters from the FCA saying, what have you done about market abuse? What have you got in place? Tell us all of your systems. And that's generated a little bit of a flurry.
Is my recommendation to the brokers is don't expect sympathy and get your act together.
Yeah. Okay. I think this is why I say everybody, we saved the best for last. And I think there's little harsh points if people are tuning in just for the last points are probably some of the most important ones that people should have gathered today. So Shai, Mark, Shiran, I want to thank you guys for being part of today's panel, and also again to Finance Magnets for putting on this event once again, and hopefully we'll be able to be back in the indoors and in the conventions together again and not through Zoom.
Thank you very much.
Thank you for having us.
Right. Thanks. Bye.